Joining us now, Constance Hunter, Senior Advisor at MacroPolicy Perspectives. Constance, thanks for joining us.
Sure, my pleasure.
Why did you pick the participation rate out in particular?
Well, because it jumped up, and that's a really good piece of news, right? Because when you look at this headline number, you could say, oh my goodness, it's going to cause inflation to reaccelerate. And the crux of why it's not has to do with supply. So greater number of people supplying labor means that it's less likely to be inflationary down the road.
How does immigration factor into these numbers, in your view?
Yeah, immigration is a really important part of this. We are adding workers when we need them, right? So we had sort of a lower increase in immigration during the 2000s. So if you go back to the 1990s, we had a much larger flow of immigrants. We had a strong economy that often attracts people to come to the United States. And it also means companies are applying for the HB1 visas in greater volume. We're starting to see that again. We have a strong economy. Employers are looking to bring in workers. And of course, we have people coming here seeking work.
Hey, Constance, it's Tim. Thanks for joining us. You're focused on macro. What's the move in gold telling you? This is somewhat counter to what the equity market is doing and maybe even what the bond market's doing.
Yeah, that's a great question. I mean, look, I'm not a gold trader. I remember starting my career on Wall Street when Wayne Angel was the gold bug, right, at Bear Stearns. And Bear Stearns got sued for him saying that gold was going to go up. It didn't go up. And he, the defense was, well, he's just there for entertainment. So look, people put gold into their portfolio when they feel insecure, right? It's like buying part of the zeitgeist. And if there's uncertainty, the value of gold will go up. We have a lot of uncertainty going on in the world, right? We have an unprecedented number of elections this year. We have a lot of geopolitical uncertainty. And I think whenever you have times of surging productivity like we have right now, because productivity is not well understood, right? It can cause increased volatility. That increased volatility also may cause investors to flock towards gold.
So, Constance, on the macro front, again, I think within the last month or so, we exceeded the 1978 to 1980 duration of an inverted yield curve. So it's the longest inverted yield curve since we started taking this data. Does that mean anything anymore? A lot of people say it's different this time. What is your sense?
I mean, look, it's certainly a concern for the banks that have the held to maturity securities that are at a loss because of that inverted yield curve. They're not lending out money at the same rate. So we're seeing it in the senior loan officer survey. We're seeing it in the willingness of banks to lend and them keeping extra cash on the balance sheet. At the same time, we're also seeing the willingness to borrow decline. Right. So you do see tighter liquidity conditions because of that inverted yield curve.
Constance, I'm wondering how you view how many cuts we will get this year and if that view has changed in the past 48 hours.
Yes, it has. So we have dialed back the number of cuts to 3 cuts this year. We still think there's a very good chance that they move in June because our forecast for the progress on inflation is fairly aggressive over the next several months as we start to see lower rents feed through into that rent component of core PCE. But we only think that they are going to cut 3 times. And by the way, this we have been saying for a little while, this is very reminiscent of the 75 basis point cuts that we got in the 1990s and a situation that perplexed the Fed and the market then when we had a productivity surge and we continued to have stronger growth, lower inflation with interest rates remaining fairly elevated.